Welcome to The Deep Dive. I'm John.
And I'm Wendy.
We're both staff here at WeWire, and we're excited to bring you this week's weekly Stay Wired recap.
Today, we're really digging into some major global events.
We are. Our sources, well, they range from outlets like Reuters and Bloomberg to the IMF, the Ronald Bank, Kelce markets.
And even insights from places like X. It all feeds into our weekly Stay Wired report.
Exactly. And the big headline, the one grabbing everyone's attention right now.
Oil markets.
Oil markets reacting sharply to Middle East tensions. West Texas Intermediate, WTI crude prices, they surged.
Yeah, and those forecasts from Kelce markets, pretty striking.
Predicting a rise to $94.10 by year-end 2024. That's what, a $21 increase in just 1 week?
A 21-wonder jump. It's huge, and largely driven by fears of supply disruptions.
Especially through the Strait of Hormuz, right? Which handles so much global oil.
A massive chunk, yeah.
Okay, so our mission today is basically to unpack this. How are these geopolitical tensions, especially in the Middle East, hitting global financial markets?
And that means everything from, the price at the pump.
To the value of your investments.
Yeah.
We'll try to connect the dots, focusing on the ripple effects in currencies, oil, and gold.
It's fascinating, really. The Middle East has definitely been a hot spot in 2024, 2025.
No kidding.
But it's the speed, the speed at which these regional conflicts between Israel and Iran, like Reuters reported, just immediately translate into global market jitters.
It really shows how connected everything is.
It does. And a huge reason for that speed is the Strait of Hormuz.
That choke point.
Exactly. Think of it like the world's main oil artery. About 20% of all global oil trade squeezes through there every day.
Wow, 20%.
So analysts are warning, quite clearly, any major disruption there, even just the threat of one, could spike oil prices by 20, maybe 30%, almost instantly.
So it's less about barrels actually stopping, more about fear.
It's pricing in that massive fear premium, and then you layer on the ongoing rivalries between big global powers.
Adds another level of complexity.
Totally. It just amplifies the uncertainty, and you see investors doing the predictable thing, running towards assets they see as safer.
You can almost feel that fear premium when you look at the oil numbers. We mentioned WTI crude surging.
Right.
And that Kelce forecast, $94.10 by year end. It's stark. A $21 jump in a single week is just massive.
Bloomberg even reported oil jumping past $80 a barrel right after those first Israel-Iran clashes. They called it trader panic.
You could really feel it. So what does this actually mean for you listening at home?
Well, directly, it means higher fuel costs.
Which hits your commute, deliveries.
Everything. Getting goods to stores costs more. So a more expensive barrel of oil usually means, well, more expensive everything.
Which brings up the bigger economic picture, doesn't it?
It does. It raises that important question about the wider ripple effect. The IMF, the International Monetary Fund, they've been watching this. And they've noted that if these higher oil prices stick around, they could seriously push inflation up globally.
Which puts central banks in a tough spot.
A very tough spot. It pressures them to rethink cutting interest rates. Might even force them to keep rates high or raise them.
Making borrowing more expensive. For homeowners, for businesses.
Exactly. For everyone. It's a chain reaction, really. Starts with oil in one region, but quickly impacts the whole global economy's stability.
And alongside oil, we saw another market react strongly. Gold, yeah. Prices soared, didn't they?
Yeah.
Near record highs.
They did. We saw reports everywhere, social media like X, traditional news like Reuters. It was a big move.
Why gold, though? What's the thinking?
It's classic investor behavior. When people get spooked by the idea of a wider conflict or just deep economic uncertainty,
They run to gold.
they flock to gold. It's seen as the safe haven asset. That surge. It's gold playing its traditional role as a hedge against uncertainty. Demand just spikes during geopolitical trouble.
Makes sense.
The World Bank's pointed this out too. Gold is incredibly sensitive to global risk sentiment. Its price often mirrors how worried investors are about, economic or political chaos.
So for the average person, rising gold prices are like a warning signal.
It signals broader economic caution, definitely. And it can affect things like the cost of jewelry, obviously, but also the performance of your investment portfolio if you hold gold.
Gold is definitely the classic safe haven. But are we seeing any shift? Like with digital assets now in the mix, is some of that capital flowing into things like crypto during crises?
That's a really interesting question. And the market's still figuring that out, I think.
Yeah.
Well, you do see interest spike in things like Bitcoin during volatile periods, but it often seems to be A different crowd, maybe more comfortable with higher risk, hoping for higher reward.
So gold's still king.
For many, yes, especially institutional investors, central banks. Gold has that history, that physical tangibility, that universal acceptance. Digital assets haven't quite matched that safe haven status yet.
Not in the same way.
Right, so while some money might go digital, gold's role as that sort of global fear gauge, it seems pretty solid.
Okay, that clarifies things. So moving from gold,
Hmm.
let's talk about the U.S. dollar. It also got a significant boost from all this, right?
It did, yeah. Strengthened quite a bit as markets reacted.
We saw posts on X noting, I think it was a 1.5% drop in U.S. stock futures. But at the same time, a rush into the dollar.
They called it a life raft.
A life raft, exactly. Which isn't new, is it, this flight to safety?
No, it stems directly from the dollar being the world's main reserve currency. It almost always gets stronger during crises because investors want its stability and, crucially, its liquidity. You can always trade dollars.
And the IMF sees this pattern, too.
Oh, yes. Their 2024 reports really highlight how geopolitical shocks consistently boost dollar demand. You see it clearly in major currency pairs.
Like Eurodollar or dollar-yen.
Exactly, EUR/AUD and USD/JPY. When the dollar gets stronger against those, it changes the game for trade. Makes it pricier for Europeans or Japanese to buy U.S. goods, for instance.
But for American consumers?
It's a double-edged sword. A stronger dollar can make imports cheaper, which sounds good. But it also makes U.S. exports more expensive for others to buy, which can hurt American companies selling overseas. And then there are emerging market currencies.
They often get hit harder.
Especially those tied to oil producers. They often face real depreciation pressure during these times, adding more economic strain when they might already be vulnerable.
It feels like we've seen this movie before, though. These Middle East tensions impacting markets.
Yeah. While these 2024-2025 events feel very immediate, history gives us important context. This isn't the first time.
Like the Gulf War.
Right. Back in 1991, Bloomberg documented oil prices spiking, 30% in just weeks?
Wow.
And then the 2003 Iraq War that drove gold to multi-year highs? These aren't isolated incidents. It's a pattern. Geopolitical tension often disrupts commodities and currencies.
And the Council on Foreign Relations points this out, too.
They observed that conflicts in the Middle East seem to have this unique power to ripple globally, mostly because of the region's dominance in oil, but also its sheer strategic importance.
But here's where it maybe gets interesting or more complicated today.
How so?
Well, history gives us a baseline, right? But today's markets feel different, more complex.
You mean things beyond just the immediate conflict?
Yeah, like the whole U.S.-China rivalry backdrop. That adds a massive layer, doesn't it? Any conflict now gets viewed through that lens of great power competition.
Complicating diplomacy, making market reactions maybe less predictable.
Exactly. Countries might align differently, and then you have digital assets. Even if they aren't the primary safe haven, their volatility and presence offer another avenue, maybe fragmenting those traditional flows to gold and the dollar in new ways.
So the market's reaction isn't just a simple flight to safety anymore. It's more intricate.
Seems like it. But, okay, pulling back from the immediate geopolitical spotlight for a second. Our weekly Stay Wired recap covers more ground, too. What else is moving markets?
That's right. While the Middle East is huge, other things are happening. Wire Times, for example, reported Japan hitting a massive M&A record.
M&A, mergers and acquisitions.
Yep. $232 billion this week alone. That's not just a number. It signals a big strategic push for consolidation, for growth. Could reshape things globally, not just in Asia.
Show some confidence, maybe, even with uncertainty elsewhere.
Perhaps. It suggests companies are willing to make big bets. We also saw mixed signals from Canada's job market, a reminder that even developed economies have their own domestic issues to deal with.
And what about Africa? Any key developments there?
Definitely. Ghana securing that $2.8 billion debt relief deal with creditors, that's significant.
How so?
It's not just finance, it's a potential lifeline. Shows international cooperation can ease debt burdens, maybe unlock some growth. And similarly, Nigerian Eurobond yields dipped.
Eurobonds.
Yeah.
Those are bonds in foreign currency.
Right, like U.S. dollars. When their yields go down, it generally signals rising investor confidence in Nigeria's stability, its ability to repay. That's a positive sign for a major African economy.
It really paints a picture of how interconnected but also diverse the global market is. And our FX Corner shows that in real time, doesn't it?
It does. That weekly snapshot is revealing.
Just looking at this week, the Ghanaian cedi slipped just 0.24% against the dollar week to date. but the Nigerian naira actually gained 0.30%.
Interesting contrast there.
And globally, the British pound was up 0.84% against the dollar week to date, and the Japanese yen gained 0.73%. It just shows that constant ebb and flow.
Absolutely. And rounding things out with the commodities corner for the week's end, despite that earlier spike and all the volatility,
Oil prices actually calmed down a bit.
they saw a modest rebound, yeah. By June 26, crude was around $65.11 a barrel. Part of that was tight U.S. supply. There was a big 5.8 million barrel draw in commercial crude inventories.
So supply and demand fundamentals still matter.
They always do. That draw put inventories about 11% below the 5-year average. As for gold,
Did it hold on to those gains?
it saw a mild pullback late in the week, easing to around $3,283 an ounce by June 27th. But importantly, it's still elevated compared to the past month, up about 1.4%.
So still showing that underlying caution from investors.
Exactly. Continued appetite for safe havens, even if it cooled slightly.
Okay, so if we try to distill this whole deep dive, the core message seems pretty clear.
Geopolitical tensions, especially that 2024-2025 Israel-Iran situation, have definitely reshaped global markets.
Pushing up oil, pushing up gold, strengthening the U.S. dollar. These aren't separate things happening. They're all tied together.
Driven by real supply concerns, but also just powerful investor sentiment and, let's face it, fear.
And the key thing is, these big market shifts, they don't just stay on Wall Street or in London.
Not at all. They directly affect your everyday life. Think about it.
Higher fuel costs at the pump.
Which means higher prices for groceries because delivery costs more.
Rising gold prices impacting jewelry, maybe your investments.
And that stronger dollar. It can make your vacation abroad more expensive, even if it makes some imported goods cheaper.
So understanding these connections isn't just like interesting trivia.
No, it's crucial, especially now for navigating rising costs and just general economic uncertainty. We really encourage you to keep track using good sources, financial news, IMF reports, think tanks like the Council on Foreign Relations. Markets are going to stay dynamic.
For sure. So maybe the thought to leave you with this week is this. Consider how even rumors, things happening far away, can actually echo right into your own wallet.
Making that global awareness not just nice to have, but a really vital tool for daily life.
Absolutely.
Well, thank you for joining us for this deep dive into the weekly Stay Wired recap.
We hope this helps you stay informed and maybe anticipate some of these global shifts.
Keep exploring, keep learning. Until next time, stay wired.
Stay Wired Weekly Recap was produced by WeWire.
A B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.